Everybody here today. Today we've got a nice session on blockchain, and I was introduced to Samuel Armes, who is, I'll give you a little background. He's got an extensive background in the blockchain and government spaces. Samuel did research for the United States Special Operations Command on Bitcoin and counter-threat finance. He also did similar research for the United States Department of State on cryptocurrency policy and blockchain technology. Samuel is currently the president of the Florida Blockchain Business Association and has passed 2 bills in the Florida legislature. He spends his free time water skiing and working for Crypto-Quant hedge fund, Hyperion Decimus. So Samuel, thank you for being here today. We welcome you and look forward to learning from you. Give a little overview to the group. We'll do about a half-an-hour presentation and have about a half an hour left at the end for questions and answers. As you have questions that might come up throughout, just put them in the chat and we'll come back to them as opportunity presents. Okay. And with that, Samuel, thank you. Welcome. It is all yours.
Thank you for having me. So I like to begin every presentation with kind of the presupposition that most everyone here, whether you believe it or not, already understands cryptocurrency and blockchain. There's just an overflow and overwealth of information that I think confuses a lot of people. So today, hopefully by the end, you're well-versed in at least the foundations, and then you can apply that to any kind of cryptocurrency project that you come across. So once again, yeah, my background, economics and international finance was my degree, but I had already been into kind of cryptocurrency and Bitcoin. Before then, I've done a lot of work with the military and with the United States government. A lot of it, the counter-threat finance, I was actually figuring out whether drug cartels or ISIS were kind of be using some of this cryptocurrency. And then I kind of got into the political process where now I actually lobby on behalf of a lot of cryptocurrency companies here in Florida. I've done most of my work on the state level, but I also do some work on the federal level as far as lobbying and legislation, which some implications of that we'll go over, by the way, at the end. And then now I work with a cryptocurrency, Crypto-Quant hedge fund here in Orlando, Florida. So what are we gonna cover today? Well, we're gonna go over some foundations and some basics. One being the history of money. 2, where did Bitcoin come from? What is Bitcoin and blockchain? What are the top 10 cryptocurrencies today, which is of course ever changing? Buying and selling cryptocurrency, and then going over some recent cryptocurrency events, which when I say recent, I really kind of mean the past 3 months, although I may go back a little bit further if anyone's interested in any of those topics. So the history of money, what is money? So we all spend dollar bills every day, right? But not a lot of people tend to think about what that actually means. What gives money value? And there are actual principles of what gives the US dollar or gold or any kind of currency valuable. And these are some of the properties. So property number 1, fungible. Units of the good should be of relatively uniform quality so that they are interchangeable with one another, which is basically why every US dollar looks the same. Gold is fungible. Most gold nuggets, most gold bars are of uniform look, right? That's how we know we can expect to interchange the goods. Durable. Physical characteristic of a good. So once again, going back to gold, for example, gold is one of the few metals that don't rust, right? Which is why it is throughout history been proven to be the backbone of a lot of our currencies. So it has to be durable, portable, right? Divisible into small quantities. So you think of the dollar, you think of the $100 bill, you think of pennies, quarters, but then you think of gold. Gold is malleable. You can break it down, right, for smaller parts. Obviously, if we had to use a gold bar for everything, trade and commerce would not be as effective. And so remember these terms, by the way, just throughout the presentation, because it's all going to eventually draw and come back. Recognizable, right? If everyone tomorrow forgot what the US dollar was and didn't recognize it, it would no longer be our currency, right? We wouldn't know what it is. So there's something embedded in the psychology of a citizenry, of a populace, that makes money what it is, right? That interchange of commerce and goods. And then stable, right? And stability is incredibly important today. And I'm going to mention stability throughout the presentation, right? If I'm using money, I have to believe that the dollar that I'm receiving for a good is going to be $1 by the day, or at least by the end of the week, or maybe even by the end of the month. If I were to receive $1 and know that that dollar is going to be 50 cents in a week or in a month, that might not be an effective form of currency in exchange, right? We would not want to use that. So given those principles in mind, here's our last set of terms I want you to keep in the back of your head. Okay, everyone knows what inflation is, right? And it kind of goes back to our original term of stability, right? Inflation. What is inflation? Decline of purchasing power of a given currency over time. Something that I think we're becoming more and more familiar with here in America every day, right? Gresham's law, which in general is incredibly important. Bad money drives out good money. Quick history lesson, the US used to be on a bimetallic standard. We used to be on the gold and silver standard. What that meant was that the US recognized both as the official currency of the United States. But because of US regulators, what would happen is they would regulate either gold or silver at a certain time. And the populace would choose whatever currency was least valuable, right? So if gold was more valuable, they didn't want to spend it because they believed that its value would grow over time. So the gold in the market in the US would be taken away, put into vaults or in people's homes or under their mattresses, and people would start using silver, right? Well, then it would sometimes reverse. Silver would become more valuable. So then people would start hoarding silver and they would use their gold because they believed that silver would hold value over time, right? Which once again, going back to our principles, kind of gets into stability, kind of gets into the idea of inflation. And then the stock to flow model. So I'm going to go over this more in depth, but I just want to make you aware of what it is. The stock to flow model is how commodities are measured. So you think of a stock, all the stock in the world of gold, let's call it 1,000 pounds. I know that's unrealistic, but let's just say we have 1,000 pounds of gold in the entire world. That is the current stock. But we're mining 10 pounds a year, right? So that mineable 10 pounds a year is the flow, right? So the stock to flow ratio takes the amount of the stock of the entirety of some asset, normally a commodity, but now applies to digital assets like Bitcoin, and creates a ratio to measure how effective they are. It's almost like a counter measurement to inflation. So it is no coincidence that gold currently has the highest stock to flow model of 62, as you can see on that graph. And gold has always been our foundation of currency up until we moved to fiat currency. So just some interesting concepts to keep in mind. So now let's get into some history. Now that we know those terms and we kind of have a good idea of what money is, let's think about where these principles have been applied. Okay, so let's go back in time. Let's go back in time to the Spanish Empire, right? Okay, so you're the Spanish Empire. And at the time, gold is still kind of the global reserve currency. Everyone in Europe, all the trade around the world, gold is the primarily used function for money. They come across an island, and this island has precious resources that they want, but they notice something weird. They notice there's no gold on the island, but there's these giant stones, right? And these giant stones are actually money. They are used as a currency on this island. Why? Well, one, the stones are scarce, right? There's only so many stones on the island. What that means is these stones on that island have a high stock to flow ratio, right? The amount of new stones that can be created is very low, right? And the amount of stones present is very high. Further, the stones are durable, right? Now, it denies some of the other principles of money. Obviously, they were not very portable. They're kind of heavy, but it was the best thing the islanders had, right? These stones at least lasted a long time. And if you're thinking about preserving your wealth, if you're thinking about Moore's law, people would hoard these stones because they knew the stones would hold better than anything else on the island. Well, the Spanish come to the island and they go, well, we're a global empire. At the time, we can get stones from anywhere. So they do. They start carving up stones and they start buying all the goods that they want and all the resources on the island. And the islanders don't second guess anything. They say, cool, more stones, more money for us. Up until the point where the islanders' goods are all gone and all they're left with are what are now useless and valuable stones. Useless and not valuable stones, I should say. So the Spanish, in a sense, created inflation on that little island's economy, right? And these stones are now worthless. And that island ended up moving to the gold standard because after the stones became inflated and worthless, gold, through their trade with the Spanish, was all that they had as a means of exchange. There's another island, similar story, but they used shell money, seashells. And it's almost the exact same process. It's an isolated economy. It's an isolated island that these explorers discover has precious resources. And the explorers, the Spanish, they say, well, we can get seashell money from anywhere, right? We have so many coastlines all over the world. Let's just grab seashells and buy up all their goods. And that is exactly what happened. These seashells on the island, of course, to the islanders were a scarce asset, and they probably lasted longer than any other material, so they made sense as a means of exchange. They were probably somewhat fungible, somewhat portable, and seashells come in different sizes, not the best currency. Well, what was most important to them was they would at least last for a while, probably compared to anything else on the island. So the Spanish come, take all their goods, give them seashells. The seashell money is now inflated. It's worth nothing. And that island eventually switches to the gold standard as well, because now they're trading with the Spanish or the English, and that is what they use. And it's the only form of money that they now have. So now we'll skip to American history, right? So that gives you a general idea of, how an individual currency can be affected by kind of a global world order, right? But we have some interesting things happen in the United States, right? One of the biggest things was, of course, the creation of the Federal Reserve by Woodrow Wilson, right? The US previously had times of kind of unrestricted growth and unrestricted recessions, right? Which over a period of time averaged out to about 3.1% for economic growth. But the swings were hard to handle. So they create the Federal Reserve to manage the money supply, to manage the US dollar, for a variety of reasons, but one, to manage these swings in the market cycle. What's interesting is at the time, still the dollar was based on gold, right? You could go to the bank at the time, and I know everybody knows this, but you could still get, say, $1 worth of gold from your bank. It was a note of how much gold you might own. But that ended. It ended when Roosevelt essentially said, we're not going to do this anymore, right? We're going to go on a different standard. And you can see that in kind of the newspaper pictures that I have pictured. And then you have Nixon, who really officially ends any kind of gold, or really what it was at the time was oil-backed currency of the US dollar, and kind of created what we have today known as fiat money. Fiat by word of mouth. Our money is worth something because the federal government says it is, right? It is backed by the word of the federal government out of nothing, hence the word fiat. Another interesting graph is the purchasing power of the US dollar from 1913, just 2 years after the Federal Reserve was created, to 2013. I wish they had an updated version of this graph. It would be interesting to see what it would be in 2021. I'm kind of scared to know. But you see that decline over time, how the US dollar has lost its value, which is funny because my grandfather, he's 91, and he still tells me stories about using quarters to buy whole entire carts worth of groceries. So it's incredible what that inflation has done. But if you remember, if you remember the Islanders and you remember some of the principles of what money is, it's important to keep in mind when looking at that US dollar graph. Okay, so what does this all have to do with cryptocurrency and Bitcoin? Okay, well, during the 80s and 90s, you have kind of this tech boom, right? computers are really getting going, especially the personal computer. Mainframes, IBM's old mainframes are being co-opted by, you know, the Microsofts of the world. And you have people who are very disaffected with the way the United States government is running things. You have these technologists, these techno-anarchists, right? A lot of you would know them as the cyberpunks, who pretty much disagree with our entire financial system, and probably government as a whole, right? They're anarchists after all. So they say, hey, we're gonna figure out a way to make our own currency using the internet, this newfound thing called the internet. We believe software will eat the world. We believe code is the answer to everything. So that's kind of what they start doing. They start experimenting with different forms of currency. They create things like digital gold, right? They create all kinds of things like DigiCash. And they're trying to figure out ways to get off the US financial system, but they keep running into the problem that no matter what they do, their solution is centralized, which means there's a single point of failure in which if the government wanted to, it could flip the switch and turn off their project. So they spend a lot of time figuring out, how do we make it so that we can create some kind of electronic currency that is decentralized, that works, right? And this is all the way back in the 80s and 90s, some of these papers were written. And a lot of the technology that's what we know as today as Bitcoin was based off of these old mathematical papers. Some, I mean, are even older than the 80s and 90s. A lot of the math that we use, funny enough, for technology has been around for a long time. We just haven't had the skill to implement it into that said technology. So that's History 101, right? And that will give you a good breadth of understanding for everything that I'm kind of going to talk about going forward. So I want you to keep the examples that I gave from the Spanish Empire in mind, what they did to those islands. I want you to keep those different aspects of currency in mind. And then everything that I'm talking about is made by the people that I just mentioned, not all of whom are known, right? Obviously, Satoshi Nakamoto, nobody knows who he is, even though some people claim to be him. We still don't know. It's an anonymous group of people. So keep those thoughts in the back of your head. So now I'm going to go through kind of our second section, which is going to be blockchain and Bitcoin 101. What is this stuff, all these terms that you hear? So one way to think about it is if you think about Amazon, the only way Amazon's able to happen is through e-commerce, right? And e-commerce applications. But e-commerce is only able to happen through what? The internet, right? The internet is the foundation of what Amazon really is and represents. No internet, no Amazon. Well, Bitcoin is similar when you consider something called distributed ledger technology, which distributed ledger technology, a ledger is just a database. If you've worked with Excel, you know what a database is, right? Excel is just a database. A distributed ledger is a different kind of database. Blockchain is a form of a distributed ledger. And then Bitcoin uses a blockchain in its ecosystem. So we're going to go over both blockchain and Bitcoin. So in a lot of ways, the easiest way to get people to grasp some of this stuff is to help them understand what Bitcoin is. Because what Bitcoin did was it took not necessarily new, actually sometimes antiquated ideas, but put them together in an economic system that makes Bitcoin function. So understanding Bitcoin will really help you understand blockchain. So what is Bitcoin? So technically this is Bitcoin. You're looking at it right here. This is about 8-page abstract paper that was released in October 31st in 2008, right? A peer-to-peer electronic cash system. Now remember, wherever this guy was, and we have emails with him and other cyberpunks that I was talking about in the 80s and 90s, he published this white paper and essentially said, hey guys, I think I figured it out. This problem of money, where we create our own currency that's decentralized, that the federal government can't turn off, that's going to be a competitor for cash. I think I figured it out. So here's my white paper. Let's get to work on it, right? So Bitcoin is the first and largest blockchain. It's a decentralized peer-to-peer network. It is known as a cryptocurrency, right? A lot of these terms came from the invention of Bitcoin. It's distributed triple entry ledger system, and it is the internet of money and value. I'll be going over all of those things. So when a Bitcoin transaction is confirmed by the network, a distributed network of trust ensures that only the owner of the asset can send it, only the intended recipient can receive it, the asset can only exist in one place in one time, and every network participant can validate transactions and ownership of all assets at any time. Okay, so how does all that happen and how does it work? So that's what we're going to walk through. The first key point is the blockchain, right? So I know everyone's wondering, you hear blockchain all the time. Blockchain's used as a buzzword in a lot of ways. A lot of you already understand what blockchain is. Blockchain is actually just an antiquated database. Okay, so think of it like this. When you type up an essay or do a newsletter or whatever you want to do on Microsoft Word, you can save and change that Word document anytime you want, right? I can backspace, I can change the entire Word document, I can do whatever I want. I can copy and paste that Word document, I can send it to multiple people. Well, if you're thinking of a monetary system and you think of what you can do with a Word document, well, you don't want to be able to easily change the amount of money that's in a supply, right? So a blockchain is kind of like a typewriter. So if you imagine you put a piece of paper in a typewriter, everything that you enter is in there permanently. And the only way that you can change what you just typed out in a typewriter is to pull that piece of paper out and put in a new piece of paper and start all over. So each block, right, is essentially one of the pages in that typewriter. And if you have any kind of error, if you have any kind of change in information, then what you have to do is create an entirely new block, right? You can't edit the first block because once you punch it in, it's in there permanently, right? Sounds antiquated, but it works perfectly in the economic system that is Bitcoin. So if you understood that, congratulations, you now understand blockchain. It really is that easy. It's an antiquated database. It's a database just like Excel, but it's like a typewriter, right? You literally, once information's put in, you can't change it. And that's all you need to know. Boom, you got it. So blockchains are linked. So this is a more technical graph, but for future reference, all you need to know is that new information isn't downloaded in its entirety into every new block. Every new block has a fingerprint of the old block, right? Because there's a certain data range in each block in the blockchain. So once again, just like a typewriter, each page is only so long, each piece of paper is only so long, right? So imagine if it's almost like page numbers, right? It's like I'm putting a page number on each page in a typewriter that I'm typing out. So I can always, if I know I'm on page 2, I know there's a page 1 that I can reference back to. If I'm on page 455,000, I know I can just go back one more and see what was on that piece of paper. So that's the blockchain, but now we want to get into a decentralized framework, right? And so the blockchain helps enable decentralization, right? And so this is a classic picture of what a peer-to-peer network is, and what a centralized network is. If you think about centralized, and I'm about to go over this example on our next slide, think of that computer in the middle being a bank, right? If I want to send someone money from my Bank of America, what does it have to go through? Even if they have Bank of America, it all goes through that centralized organization. But we want to get rid of that centralized form, right? We do not want any Bank of America. We don't want any off switch, because in the picture on the left, if you get rid of that computer, the whole network shuts down, right? On the picture on the right, if you get rid of just one of those computers, well, there's still 4 more, So we're still good to go, right? And you can imagine currently in the Bitcoin network, there's hundreds of thousands, if not millions of computers, right? And you have to disable each and every one. So what does that look like in practicality? Okay, so I have $10, right? If I want to send anyone in this chat $10 through Bank of America, you give me your banking information. And I give that to Bank of America and I say, I want to send this person $10. Bank of America computes that transaction, right? We don't think about it often, but what that is an equation, right? Just like 2 + 2 = 4. The equation is Sam wants to send, we'll say Steve, $10, right? So Bank of America computes that transaction. They solve that equation. The equation is Sam has $10 in his bank account. Sam wants to send Steve $10, right? They compute that equation. Now I have $10 less in my account and Steve has $10 more. Okay, so that's Bank of America's function. How do we get rid of Bank of America, or what happens when we get rid of Bank of America? Okay, so imagine this, because now there is no bank. There is no longer a centralized person to solve that equation for me. Now on a peer-to-peer network, right? Like the graph previously, I can even go back. We're the decentralized. We have all these computers right to the right. So what happens is I raise my hand on this network and I say, I want to send Steve $10. Will someone compute that transaction for me? Will someone solve the equation? Someone, one of these computers out here says, I'll do it. I will solve the transaction. I will compute the equation. I will do what Bank of America does. And that's exactly what happens. They compute that transaction. I lose $10 and Steve gains $10, right? But you have to think there are real world costs that go into that, right? When Bank of America, and we don't think about it, when Bank of America runs those services for us, I'm kind of picking on Bank of America. It could be Wells Fargo, could be your credit union. So don't get offended if you work at Bank of America or use them. I also use Bank of America and a credit union. Bank of America computes that electricity, which has real world costs, right? Electricity, we have to pay an electricity bill. So how do you incentivize someone to compute a transaction, to volunteer to solve my equation and give Steve my $10? How do you incentivize that, right? Well, there's multiple ways to incentivize it across a distributed network, right? And another aspect to think about is that each of these computers is nodes, right? And these nodes reach consensus. So on that blockchain, they reach consensus every 10 minutes, right? Which means a new block is formed on that blockchain every 10 minutes computing our data. But we got to figure out an incentive to pay that random person who's going to compute my transaction. And that is where Bitcoin mining comes from. And that is why you hear a lot about Bitcoin mining. So a miner is doing two functions, right? Function one, a miner is generating algorithms using electricity to run the Bitcoin network, right? And all that means is they're being the Bank of America. They are solving my equation. They are allowing me, when I raise my hand and I want to send Steve $10, it is the Bitcoin miners who say, we will solve that transaction for you. We will do what Bank of America normally does. Okay, so that's function one. But if you look, and you can see even in the bottom right photo, right, you see that giant server farm. That's not cheap. That's a lot of electricity, right? That has real world costs, right? How do we pay for that? Well, the way they pay for that is miners receive Bitcoin in exchange for solving that transaction. Just like mining gold in the real world, right? When you mine gold in the real world, it used to be really easy. It used to be, you think of the California gold rush, you think of when the Spanish first discovered gold in South America. All that gold was surface layer. It was easy to get to, easy to mine, right? But over time, it's harder and harder to find gold, right? And it's harder and harder to mine it. It used to be that on this laptop that I'm using right now, I could use this laptop to mine Bitcoin, and I could mine hundreds of Bitcoin a day. But now that server farm in the bottom right, they're probably mining, I mean, even with that amount of computer power, they're lucky if they're mining 10 Bitcoin a day, right? If even, because mining gets harder and harder. Why does mining get harder and harder? Because Bitcoin in its algorithm has what's called the halvening, right? Which means every 4 years, the Bitcoin mining reward that you get for solving a transaction, which that transaction is Sam sending Steve money, it's cut in half. It used to be, if you can see on this graph here in 2009, you'd get 50 Bitcoin, right, for solving a transaction. 2012, 25 Bitcoin. 2016, 12.5 Bitcoin. And now in 2020, which was the most recent, it was 6.25. Now, this is interesting because, okay, so one, miners have those two functions. One, miners are allowing the Bitcoin network to literally run, right? No miner, I can't send my money anywhere. So Bitcoin's pointless. So without miners, I can't send my money. So that's function one. Function two is they're adding new Bitcoin to the network. Like they are physically mining for it, just like if we were to mine for gold. But remember, why does gold have the highest stock to flow ratio? If you go and remember when we were originally talking about the stock to flow ratio, gold had a stock to flow ratio of 62 because the stock of gold currently, once again, let's say it's 1,000 pounds, is a lot higher than the flow, right? Which let's just say it's 10 pounds. So the stock of Bitcoin is 21 million. And that's a number that you hear often, right? There's only 21 million Bitcoin to ever be mined. But it's getting harder and harder to mine that Bitcoin. What does that mean? That means Bitcoin stock to flow ratio is getting higher, right? So right now, Bitcoin stock to flow ratio is 25, which is lower than gold, but higher than silver. By the time of the next halvening, it's supposed to have a stock to flow ratio higher than gold, which is currently 62, right? So hopefully now you're kind of getting the concept, right? Bitcoin is not just a technology, it's a bunch of technologies that are in this ecosystem that are working together to make it so there is no centralized entity for a global technological currency, right? The graph on the top right is the total terahash rate, which is what's used to measure the amount of electricity that a miner uses. What's kind of cool, and we'll go over this in current events, is you see right here, you see how there's a giant dip down. I don't know if a lot of you remember, but used to be 40% of all Bitcoin mining was in China, but China banned Bitcoin mining. So now all of that's moved to America, funny enough. And we'll get to that later in some of our recent events. So this is a little bit less important, but it's still good to know because I don't want to get into some of the technical terms behind cryptography, but all you really need to know is if you remember when I was talking about the blockchain function, and you remember how each block has a fingerprint equivalent to a number page on a typewriter, that fingerprint is called a cryptographic hash function, right? And that is what holds a lot of our information. So a lot of people think or ask the question, why is cryptocurrency so secure? Why is it that I can simply mask my presence in some ways? Because I'm sure a lot of you are familiar with the stuff on Silk Road and how a lot of cryptocurrency was used at the time. It's not so much anymore for criminal activity. Well, it kind of works like this. You have a private key and a public key. And all you really need to know is this. When you create a Bitcoin wallet, that wallet has a private key and a public key, right? It's easy to think of that like a PO box, right? The public key, I can go, and if I know your PO box number, I can put normally almost any kind of letter in your PO box, but I can't get to that letter, right? I don't have the private key. The private key is the key to that said PO box. And without that private key, you do not have access to that PO box, right? But unlike that PO box, you can't have a spare key made. right? If you lose that private key, your Bitcoin's gone forever, right? And there's multiple cases of this. You'll see on the news all the time. I think they were dumpster diving in England because a guy had a hard drive that he threw out his private key on, which had like a couple thousand Bitcoin on it. And he literally offered a reward. He's like, if anyone can find my hard drive with my Bitcoin on it, I will give you half of it. You lose your private key and it's gone. Such is the responsibility of not having a bank to back up your asset, right? Bitcoin is kind of an ultimatum in personal responsibility. So if you lose that private key, there is no FDIC insurance, right? That's all you got. Okay, I see one chat here. Okay, James, how does Bitcoin relate to USA or Chinese currency becoming insolvent or currency crisis like Daniel Gabriel talks about in his book, History of Debt? I'll save that question for the end because it's very relevant to some of the current events, but that's a very good question. And we're almost there. I'm almost done my presentation, so I'll get to your question shortly. So one more key concept, right? We've talked about Bitcoin. You hopefully get it, right? You get blockchain. Blockchain is just a database that once you put information in, you can't take it out. You get what Bitcoin mining is and the functions that Bitcoin mining does for the ecosystem. But these people, after Bitcoin was released, said, wait a minute, Bitcoin's just information. It's code, right? Well, what else is code, right? Or what else can be code? What about voting? What about ownership? What about titles? What about healthcare? All that's on the internet. And we use third parties for that. Well, what if we got rid of that third party and created a similar ecosystem like Bitcoin did? So Bitcoin's using blockchain to back its currency as a use case. But what about other use cases, right? What about just using smart contracts for real estate, right? What if we don't need the third-party intermediary? How can we come up with some kind of token and some kind of economic system that gets rid of all the third parties that we experience throughout our daily life, right? And so that's kind of what you're seeing with the literal over 2,000 different cryptocurrencies that are out there right now, is each one of them, for the most part, some of them are trying to claim to be trying to be a better currency than Bitcoin. But others are saying, hey, let's just do what Bitcoin's doing, but let's apply it to real estate. Let's apply it to titles. Let's apply it to healthcare. Let's apply it to any kind of commodity, any kind of industry, right? So just for fun, right? Let's look at what the top 10 cryptocurrencies are today. What's really funny is the last time I gave this presentation was at the beginning of the year. And at the beginning of the year, if many of you remember, Dogecoin was actually the top 3. It was the 3rd highest cryptocurrency of all time, right? There was a lot of hype around it. I'm sure a lot of you were hearing about it, but that's not the case today. XRP, what's funny is how much this changes over the years. Of course it will, but even XRP back in 2017 during the ICO boom, XRP used to be number 3, but now it's Cardano. But Bitcoin has stayed at number 1. Bitcoin's kept its top spot. This was just a week ago. Here's our Dogecoin though. It's number 10 now, right? But each one of these cryptos, I guess I should go back. Each one of these cryptos, once again, is trying to solve a different problem. Bitcoin's often described as digital gold. Ethereum has been called digital oil. Ethereum's trying to be used not so much as a currency, but as a platform on which everything can be built, right? Cardano's trying to do the same thing, but they claim they can do it better than Ethereum, right? Tether, of course, which you may see in the news a lot. You're going to see it more because regulators are looking at it heavily, is a stable coin, which a stable coin just means it's always going to be valued at $1. But you have 2 types of stable coins. You have one type of stable coin that's an IOU, which means they're just supposed to have $1 in their quote unquote bank account as a reserve. But then there's algorithmic stable coins, which means it algorithmically just tries to match the price of the dollar. But that also means that they can print as many as they want. And right now, if you look over here, there's 68 billion USDT, right? Which is very questionable about, where a lot of those Tether are going. A lot of you are probably familiar with XRP. For a lot of people, XRP was their gateway into crypto. They, of course, if you even see here, they won a court case a while back, claiming that they were security. And of course, that made the price jump because they got fined instead of going to jail. So price would have dropped if they went to jail, but they just got fined. So they're doing good. And then we just have some of these others. Uniswap, of course, is one of the larger DeFi exchanges, which DeFi is an entire animal in and of itself. But DeFi, once again, you're taking the principles of getting rid of the middleman. DeFi saying, how do we loan each other money without a middleman? DeFi is, but it's different financial instruments throughout that, throughout these decentralized financial applications. So buying and selling cryptocurrency, I mean, it's not as hard as you would think. A lot of times I tell people, if you haven't dabbled in it yet, just go. I use Coinbase and Coinbase Pro, but you're welcome to use any of these. A lot of people use Kraken and Gemini. Binance, we'll see what happens. Binance technically isn't allowed in the United States, but they have a version called Binance.us, and you can use that. But they're also undergoing some regulatory drama. But you go on one of these, you register. Now it's funny, they're more compliant. You have to sometimes give your social security number, or you have to give a picture of your driver's license. When I first signed up, I didn't need to do either of those things. I could just sign up and either use a credit card or debit card. But now most of the time they make you actually connect your bank account. And once you connect your bank account, you're able to buy it. And you can buy, depending on your exchange, $10, $100, $1,000 of Bitcoin, Ethereum, whatever you like. A lot of you have heard about wallets. I mean, once again, a wallet, you kind of think of it like a PO box, or you could think of it like a physical wallet, right? It's just where you store your Bitcoin, right? And all that means is a lot of these wallets, funny enough, cryptocurrency, the whole goal of Bitcoin is what? It's to be decentralized. But we're buying it on an exchange, and sometimes we're holding it on an exchange. And these exchanges are centralized entities. So back in the day, which by back in the day, I mean like 3 or 4 years ago, but even before then too, there are a lot of exchange hacks, right? Because they're centralized servers. So as long as you can get into that centralized server, you can get access to people's crypto. And that still happens on certain exchanges. Most of them Asian now, because the American exchanges are pretty well on the side of security. I mean, Coinbase, of course, just went public. So if their security isn't down pat, I mean, you're going to see those shares go way down. But they've made substantial investments, but they are still centralized servers. So if you don't feel safe having your money on Coinbase, a lot of people download applications on their phone, or they have like a Trezor or a Ledger Nano. They're these flash drives, right? It's a flash drive you plug into your computer, and you can put your cryptocurrency on that flash drive, right? You lose the flash drive, you lose your crypto, it's gone forever, right? Once again, your private key, you lose it, it's gone. There is no FDIC insurance. At the beginning, me and Sam were talking, just a quick note on, you probably heard cold storage, hot storage. Cold storage, all that means is it's not connected to the internet. So if it's a Ledger or a Trezor, which are like a flash drive, as soon as I pull that out of my computer, it's not connected to the internet. That's what we call cold storage. Hot storage is anything that's connected to an application. So that would be a Edge wallets or an Exodus, just applications on your phone. All right, so the fun stuff, recent events, current events. All right, did we get another question? A friend of mine had his wallet hacked into, and then they transferred to someone else. Is there a recourse for him to get his coins back? That's another good question, James. Unfortunately, probably not. And I will tell you why at the end of current events. So I've also had friends who I've actually been hacked as well. So sometimes it's just part of the game. Yeah, I'll go over that. So recent events. So Bitcoin did become legal tender in El Salvador, right? So it is up in par with the US dollar, because the US dollar is another official currency of El Salvador, but now you can do Bitcoin, which is a pretty big deal. First country in the world to say Bitcoin currency is going to be right beside our national currency. A pretty big deal. There's about 6 million El Salvadorians within El Salvador and about 2 million in the United States. And a large chunk of their economy is, of course, based on remittances. So now with Bitcoin being a currency, they're not going to be using Western Union too much, right? Why would they just not use Bitcoin or even another cryptocurrency, whatever has the least amount of fees to transact with that value? Elon Musk was really popular at the beginning of the year. He was shilling Dogecoin a lot. He actually, and this is my last slide has a graph on that. But he put Bitcoin on Tesla's balance sheet, right? Which was a pretty controversial move. And he still has crypto on that balance sheet, just Bitcoin though. And he's been a pretty big proponent of it. NFTs. So if you think, once again, one of the key concepts, and I know a lot of you have heard about NFTs, NFT just stands for non-fungible token. And if you think about Bitcoin, you think each and every single Bitcoin, right, is neither created or destroyed, right? So the idea of a non-fungible token is, let's just do what Bitcoin did, but instead of being a currency, what if we turn like our piece of digital art into a non-fungible token, normally based on Ethereum, and kind of like a blockchain? What if we made it so that no one can simply copy it? Or if they do copy it, we can prove it. So NFTs are just a way, I mean, you can imagine, I can take a screenshot on my cell phone, right? If I have a relationship with someone and they share me their first digital drawing, well, I can screenshot that digital drawing and I can claim that I did it, that drawing is mine. And I can go on and say I saw it. Well, you know, how do you stop someone from being able to do that? Well, you do that by creating a non-fungible token. So all that really does is it creates a hash. If you remember those little fingerprints that we saw on the blockchain, puts a fingerprint on the picture, turns it into a token. And now I know, because of that fingerprint, that is the original, the first of that, say, digital drawing or painting or what have you. It's pretty cool. I mean, you're seeing a lot of NBA, NFL players get involved in these NFTs, because what comes to mind? Baseball cards, right? But what about digital baseball cards? How do I prove that this is an original, right? Well, they're using the technology that kind of Bitcoin hashed together, and they said, okay, let's just fingerprint it, right? Is it overhyped? Yeah, probably. I mean, should that, they're called oh shoot, I forget what they're called, something ape. That's one of the many apes, that NFT on the photo. Should they be trading for a few $1 million? I personally don't think so. I know art can be very subjective depending on who you talk to. Maybe someone thinks that ape with the hat is worth a couple million. I do not. But there are many such cases. So is there overhype? Is it an overheated market? Probably. Is the SEC and the federal government going to crack down on NFTs? Probably. Some of them are kind of being used like securities. But it's to be determined, right? And it gets hard because a lot of these NFTs are being traded over DeFi, decentralized applications, which means there's no organization. So how do you regulate just a piece of software people are using, especially if it's decentralized? Kind of gets fishy. And then China banned Bitcoin again. They've banned Bitcoin multiple times. A lot of times they just do it, I think, just to try to control the market and keep prices down. One of the biggest news pieces was, like I said in the beginning, about 40% of Bitcoin mining was in China. And you can see that here. Oops, let me go back. You see that here. But they banned Bitcoin mining. And within 2 weeks, boom, it plummeted, right? What's funny is, I mean, 40% of Bitcoin's network was taken out. But Bitcoin, you would have never noticed. Things didn't really change. The algorithm corrected, right? The miners were still getting their rewards. Now, all that mining power is moving to the US, right? And is slowly climbing back up to its pre-high levels, right? It's like going to eventually just be an unbroken trend, which is incredibly impressive. You think about taking out 40% of any infrastructure for anything in the world, 40% of our food supply chain, 40% of our oil supply chain, 40% of our shipping supply chain. I mean, mass chaos is one way to say it. But with Bitcoin, there was really no noticeable difference, right? All the other nodes in the network picked up the slack. Miners everywhere else in the world continue to mine. And the miners that were in China, they left and they sought out efficient energy resources elsewhere. And now the US, I just read an article today, has 30%, 35%, I think, of all crypto mining. Which that, if you think of North America, because a lot of it's in Canada, because it's cold, that North American number is probably higher. And then once again, just a normal, another cool fact, especially with business applications, there's a growing number of companies that are holding Bitcoin on its balance sheet. Instead of holding cash, they're holding Bitcoin, right? MicroStrategy and Michael Saylor are pretty famous, right? And you can see the amount of Bitcoin that they're holding. Tesla, obviously. Galaxy Digital is, we work with them a lot in the crypto hedge fund space. This one, the red, that's Voyager. They're a company that has a digital wallet. And then Square, which is of course owned by Facebook, which is also in partnership with Cash App now, on their balance sheet. So there are also ETFs and countries that own Bitcoin, which is very interesting. You have Bulgaria, right, which actually has over 200,000 Bitcoin. El Salvador only has 700 right now, but they're planning to double down on that and buy more. And of course, El Salvador is still the only place where it is legal tender. Ukraine and Bulgaria and Georgia, even though they own Bitcoin, it is not recognized as legal tender. And that is the end of my presentation. I know I talked everybody's ear off. So now I'm going to go back and answer some questions and hopefully open it up for questions. If any of you, have any questions after we're done, feel free to take down either of those emails. One's my hedge fund email. The other is my association email. You're welcome to use either or both of those. And I'm always doing my best. Of course, my time's limited, but any questions that you have, I always try to answer. So let me go back to, let's see, how do I get back to the comments? Because I want to answer some of your questions. Oh, it's going to be in here. Okay. Sorry that you guys have to watch me do this. All right. So how does Bitcoin relate to USA or Chinese currency becoming insolvent or currency crisis? That depends, right? So if the US dollar becomes insolvent, I think you're going to have what I would call a cat and mouse situation, right? The inflation rate in the United States right now is, depending on what industry you're in, pretty crazy, right? We're seeing inflation in gas. We're seeing inflation primarily in foodstuffs. Of course, the federal government, it's been doing this, I think, since the 80s. Anytime inflation gets bad, they just change the basket of goods that is being used to measure inflation. So when food inflated heavily this year, guess what they took out of the basket? Food, right? So the US dollar is still the gold standard around the world, and we're still going to be seeing the US dollar being the main form of currency transaction for now. When that is so, I don't think it's going to happen overnight that we're going to wake up tomorrow and no one's going to use the US dollar. But it will get to the point where, man, like right now, the mayor of Miami they're pushing forward a proposal to pay their employees in Bitcoin. So what happens when the US dollar is viewed as so terrible when I only want to work for a company that'll pay me in anything else? And maybe that anything else is Bitcoin, right? I could go on forever about the implications of this. But Bitcoin stuck around, and if other currencies can't compete by being deflationary as well, I don't want to say they're going to die, because I don't think the nation state's necessarily going to die. I think, the United States and China will continue to be around, but maybe it makes them more responsible in their financial policy, or maybe it's like going back to the gold standard, right? And maybe simply like before fiat money, I could take my gold and I could go use it in China, Pakistan, Africa, Europe, South America, and North America, right? So we already kind of had a global reserve currency. So maybe we're actually just going back to that. So James, again, a friend of mine had his wallet hacked into. Then they transferred to someone else. Is there a get his coins back? I don't think so. Why? Well, that's really case by case basis. It depends on how the money was hacked, right? But it's not like a bank, right? It's not like a credit card. My credit card gets hacked, I just call my bank. I cut off the credit card, they give me back my credit. Crypto, it's a one-way transaction, right? There is no bank. So that's always the downside, right? And that's why security is such a big aspect of crypto. And that's why a lot of people recommend cold storage, having it on a device. Because as long as it's not tied to the internet, no one can steal it. But they could steal the flash drive, right? Of course, the flash drive is probably password protected, but once again, you are your own bank. So now you are personally responsible for that. All right, Tony, how does tax work with crypto? So it depends. Right now, Bitcoin is viewed as a commodity. It's viewed as an asset. So it's treated like one. Just like if you're holding gold or buying a house, Bitcoin is viewed as the same. The IRS views it as property, as a commodity. So you're subject to capital gains taxes, short and long term, depending on how you handle it. The tax implications behind it being on your balance sheet are a little more complicated. I mean, it's interesting because you have the gap rules and the unrealized gains. So, right, if your company buys Bitcoin at 50K and it drops down to 40K, that does show up as a loss for your company. So you could be having a great quarter, but if you're Elon Musk and you have all that Bitcoin on your balance sheet and Bitcoin does poorly, that's going to show on your numbers, and it's going to make your stock go down and look bad, which could be good or bad, because if you know your company's doing well, but the stock's low just because of the value of the Bitcoin that you're keeping, maybe that's a great time to buy, right? Mining seems to be similar to banks functioning of clearing, a transaction which could be an infinite activity, unlimited amount of transactions, but they are also mining a finite amount of Bitcoin. What is the distinction? That's a good question. There may not necessarily be a distinction. What will happen is once all the Bitcoin is mined, right, which in one technicality will never happen because there will always be 0.00000 to infinity number of Bitcoin being mined. But eventually it's going to be such a small amount that it's not profitable. Miners will simply charge transaction fees, right? So when you send Bitcoin, and if anyone's done this before, great, you kind of already get it. If you haven't, when you buy Bitcoin, say on Coinbase, and I want to transfer it to a wallet that's say on my phone, that's not free. The Bitcoin network charges me a transaction fee to do that. Those transaction fees on Bitcoin and some other cryptos are incredibly small. Like, we're talking a 0.00% sometimes, but they're strictly demand-based. What's funny is Ethereum, the second largest crypto transaction, has an incredibly high transaction fee, which is what's making it screw up in a variety of ways, right? So in short, to answer your question, they are acting as a clearinghouse, but even though they're mining, eventually, just like real world gold, there won't be too much more Bitcoin to mine, and those miners will simply be still running the network, but they're going to be funded through Bitcoin transaction fees anytime we send it. Doesn't the variability in the value of Bitcoin make it difficult to use as a reliable currency? Yes and no. So once again, it's a new commodity, just came out in 2008. We're still undergoing what I would call price discovery. So another fun fact, Spanish Empire. I know I keep going back to that, but the Spanish, when they first discovered their giant gold deposits in South America, they grabbed all that gold and said, we're rich. Look at all this gold that we have that the rest of Europe doesn't have. Well, when they grabbed all that gold and they started bringing it home to Spain, what did it do? It inflated, right? And at the time, this is going to sound like not like much, but it actually raised the inflation rates of gold at the time from about 0.003 to about 1 to 1.5%, which literally wrecked the Spanish economy. But now gold's a pretty stable asset, right? So, I mean, there's never been an asset or a commodity that hasn't gone through price discovery, and Bitcoin's the same. We're still early, we're still young. The actual value of Bitcoin is still being discovered, right? The percentage of people around the globe, although climbing, that use Bitcoin isn't very high, right? So, it will be difficult to use as a currency right now, but it's still a store of value because of that stock to flow model and because it's deflationary. That, for example, if I had $1,000 in the bank and inflation rate's 13.5%, I'm definitely going to want to keep that money in something like Bitcoin, which I know is going to keep going up over time, right? Even if it has price fluctuations. I mean, back in 2017, beginning of 2017, Bitcoin was $1,000. End of 2017, it hits 20K. Then it drops down to 3,500 at the low. Well, to me, if you measure Bitcoin from 2017 till now, and you measure the inflation rate of the US dollar, albeit still low, but still high enough from 2017 to now, your $1,000 would have been better well kept in Bitcoin during that same time period. All right, James, why wouldn't, okay, let me make sure I didn't skip a question. Yep, James, why wouldn't owning Bitcoin be viewed as a cash savings account? I don't know. No, probably particular reason. I mean, every federal agency has come up with a different view of crypto, which is one of the problems. We're now deciding that Bitcoin is a commodity and everyone's kind of agreeing on that, but all the other cryptocurrencies is still yet to be determined. The SEC calls a lot of them securities. The CFTC calls a lot of them commodities. The IRS says it's property. The Treasury, Department of Treasury treats it a lot like a currency, right? Because they're mainly focused on money laundering. So it's really hard to kind of slap any kind of definition on it. I guess crypto in general, it's hard to slap a definition on, right? Bitcoin, cash savings account. I mean, the US government also doesn't want to recognize Bitcoin as cash, right? They don't want to say, like El Salvador is doing, that this is another alternative, right? They don't want it to be a currency. Because that also changes how it's taxed, right? And currency is taxed a lot differently than property, right? Or say a commodity. So, still yet to be determined. If I had my way with the federal government, we'd be doing all kinds of different things, but I do not. And so still yet to be determined. All right, Tony, do you feel there's a greater opportunity in altcoins or Bitcoin to grow? Also, what do you think of the Bitcoin? Okay, so I'm not an investment advisor. This is not investment advice, right? This is just my opinion. It depends, right? I mean, I think, where will Bitcoin be in 5 to 10 years? My favorite answer to give is, I think Bitcoin in 10 years, one Bitcoin will easily be worth $1 million, right? Easily. But on the flip side, so could a bag of bread, right? We're measuring things in terms of dollars. I don't know what runaway inflation is going to be and how badly it's going to hit the US economy. I might, right? My mac and cheese that I buy at the store might be $100 all of a sudden one day if we get to hyperinflation. So saying what will Bitcoin be valued in 5 to 10 years also is kind of like asking, where do I think the US dollar will be, right? So maybe if it is valued at $1 million in 10 years, maybe $1 million isn't that much, right? Maybe that's nothing at all. Maybe, it will eventually get to the point, potentially, right? I'm not trying to be doomsday, but where it's just impossible to measure things in dollars, right? Altcoins and Bitcoin, it's almost like too personal of a question to ask. If I'm getting involved and getting my feet wet in crypto, I tell people just buy Bitcoin. The general Warren Buffett advice, don't invest in something you don't understand, right? And hopefully I've helped you understand Bitcoin. The other alt currencies, altcoins, of which there are thousands, each one has a different use case that you have to wrap your head around and try to understand. And that's true with all of them. So I think I draw a line between investing and betting. I think if you want to bet on certain currencies and hope you get lucky, you can definitely do that. People got rich off Dogecoin. Dogecoin is backed by nothing. It's a meme. It's a funny dog. They had a very welcoming community on Reddit, which is why it stayed alive, but it was made as a joke. It was literally made as a joke. So people who owned 500 million Dogecoin owned it for no other reason than to own it because they thought it was funny. When it mooned, right, and hit, 60 cents? No one was expecting that, right? I mean, it partially mooned because the people at Wall Street Bet said, we hate this financial system. We're going to invest in Doge just for fun, right? Is that going to happen with other altcoins? I don't know. I can't tell you. I can't predict the future. Do I know the next Dogecoin? I don't. Do I think Dogecoin's a worthy investment? No. Did people get super wealthy off of it? Yes. So things like that are incredibly hard to predict. But I personally, for sake of simplicity, I normally tell people, do Bitcoin. I do think it's the ultimate hedge against inflation. If you see or hear another cryptocurrency that you think you can make money on, go for it, but be prepared to lose it, right? Just like the real market, the cryptocurrency market is still made to steal your money, right? And you might miss that opportunity when it moons, and you might just be a bag holder, right? Stuck with a worthless crypto and wishing you hadn't invested. So a very, very case-by-case basis, I would say.
All right, Samuel, that was great. Thank you. Thank you very much. I don't see any of the questions here, so I think we're pretty good. You gave us a nice rundown, a great history lesson, and some future knowledge to bolster our banks with. So thank you very much for the time you spent with us. We really appreciate it. With your permission, we usually keep this recording live for our members for a couple of weeks. Are you okay with that? Just so people who weren't here can go back and replay it and take notes on what you had.
That's perfectly okay.
Awesome. Any final thoughts or questions? No, we're good. So thank you so much. I know we went a little bit over. I want to make sure we're respectful of your time, but we really appreciate the insight.
Thanks, Sam.
Thank you.
All right,
Thanks,
everyone.
Thank you.
Thank you.
Bye-bye.
All right. Bye-bye.